Fidelity, Schwab to roll out fees for certain ETFs. The leverage shift starts now. Here is the signal that separates noise from actionable change. We will map trigger, incentive shift, and downstream impact before the close. Now, this might sound like boring finance news. But for creators, investors, and anyone managing their own money, this is the moment everything changes. Here's what's happening. For years, zero commission trading and commission-free ETF access were the baseline. Fidelity and Schwab built their entire reputation on this. Robinhood made it famous. Everyone else followed. The race to zero had won. Until now. Starting this quarter, both platforms are introducing new tiered pricing structures on specific ETF categories, mainly complex, low-volume, or thematic funds. This isn't across the board. Your typical S&P 500 ETF is still free. But if you're buying a specialized thematic fund, a leveraged ETF, or something with thin trading volume, you're now looking at transaction fees between $2 and $5 per trade, sometimes higher. Why now? Three things converge. First, market fragmentation has exploded. There are now over 2,600 ETFs in America, up from 600 just 10 years ago. Most of them trade on thin volume. Clearing these trades costs the brokers real money, especially on small orders. Second, AI-driven retail trading has created a surge in unusual trade patterns. Microcap funds, sector rotations, and experimental portfolios are moving fast through their platforms. That's operationally expensive. Third, and this is the critical part, both firms are signaling to their competitors that the commission-free race is over. So what does this mean for creators? For most creators earning money through ads, sponsorships, or product sales, your investment accounts are fine. A creator managing $50,000 in a simple portfolio of index ETFs will see zero impact. But if you're a creator who's building a personal brand around investing, a trading channel, a portfolio sharing account, or a fintech content play, this changes your narrative. You can no longer tell your audience that commission-free trading is universal. You now have to mention fees on specialty ETFs. That's a friction point in your content. It's a reason someone might switch to a competitor. And it's a signal that the brokerage ecosystem is shifting from a race to zero toward a segmented market where basic services are free and anything specialized costs money. For the broader creator economy, this matters in three ways. First, it fragments the investing narrative. Creators who've built content around free unlimited trading now have to recalibrate their pitch. Second, it creates opportunity. A creator who deep dives into which brokers still offer free ETF trading or how to optimize your ETF portfolio to avoid fees now has a viral angle. Third, it signals that fintech democratization has hit a limit. The next phase isn't about making everything free, it's about making everything convenient, and convenience has a price. Here's what's coming next. Other brokers will follow. Interactive brokers, Tasty Trade, and smaller platforms will face pressure to announce similar fee structures within the next 30 to 60 days. This will create a brief window where creators can position themselves as the experts explaining these changes to their audiences. The platforms that resist and keep fees at zero will market that aggressively. The platforms that accept fees will emphasize research, tools, and premium services that justify the cost. For creators managing their own investments, the practical move is this: consolidate your ETF positions into high-volume, broad market funds before the fee rollout fully hits your account. If you've been experimenting with niche thematic ETFs, that window is closing. And if you're creating content around investing, this is your signal to either pivot toward fee optimization content or partner with a broker that's staying commission-free, because that partnership story is now worth telling. The creator economy thrives on leverage and efficiency. Zero fees were a form of leverage. That leverage is contracting. What creators do next will define how they stay competitive in a market where free is no longer the baseline. Watch this closely over the next few weeks. Fidelity and Schwab just did the unthinkable, they're charging fees on ETFs. For years they promised free trading. Now certain ETFs cost $2 to $5 per trade. This matters for creators because everything built on the free investing narrative just shifted. You can't pitch your audience unlimited free trading anymore. And for creators earning through investing content, this is your moment to reposition. The platforms that stay commission-free become your story. The ones adding fees become your cautionary tale. The creator economy just got more expensive.